idea of reflexivity, right, which is what we're talking about, I think this has been around for some time, and it counters the efficient market hypothesis, I think, quite eloquently. And people have different levels of intuition as to which one of those is actually true. But I think it might be helpful for us to go down a couple of concrete examples. And maybe, I guess, the most poignant one would be value, because of how long the winter has been for the value factor.
Yeah, I mean, it has been just a terrifically terrible winter for value. And I wish I had a chart up that I posted earlier. I could probably grab it out of Slack. But I mean, if you examine, for example, the returns to the S&P, I think it's the S&P Core Small Value Index, which actually has a bit of a quality tilt to it.
Is this?
Yeah, you can probably pull it
equity
up.
Equity only indices. Is this the one? The figure 6? Yeah, here, let me
No. It's a stock charts chart that I dropped in one of the channels. But anyways,
yeah, I'll find it.
Yeah, if you look at just the performance, the cumulative performance of owning this small cap value index fund relative to the market, just an S&P 500 index fund since 2018. I mean, it's been almost a straight line down. We're talking like a over -1 Sharpe ratio. So this unbelievably persistent and painful negative trend, right? And yeah, for some reason it's not showing very well, but sort of flashing. But yeah, there it is, right? So the S&P Small Cap 600 Value versus the S&P 500 ETF. Right, you've got a cumulative discount of 35% over the last almost 3 years, and so it's. I mean, but the owners of value obviously would look at this and say, well, this happens every now and then, and it did. It happened in 2000, or sort of 97, 98, 2000 during the final run up of the tech bubble. Obviously, if any effort to prioritize cheap stocks was just excruciatingly punished during those 3 years. And we're seeing a similar sort of dynamic play out here. And I will say, after the 2000 crash, there was a short period when value really had a great run. But the fact is, I mean, if you look at value as a factor using many of the common value metrics, over even the last sort of 30 years, you really haven't observed any meaningful premium, especially if you compare it to its sort of anti-cousin growth. If you compare value against growth, they both basically delivered the same returns. And according to the economic explanation for the value premium, there's no reason why that should be, right? So, and keep in mind, the original value work was published by Fama and French. I'm sure there's other value stuff that was published prior to that was seminal to Fama and French, but the most cited work was published in the very early 1990s. And if you look at the returns to value versus growth since that publication, they've been basically the same. But prior to that publication, the returns to value were massively larger than growth, right?
Right.
So just an example of how publication changes the state of the environment in which we all operate, right? We all operate in this substrate, which is markets, and we're all trading against each other, and the price of every stock and every commodity is priced at the margin. So the marginal demand by buyers and sellers. And what we observe is that post-publication, there are smart, motivated arbitrageurs that are identifying this opportunity, and there are flows driving into the opportunity to arbitrage it. And in many cases, once those flows go above a certain threshold, then it completely arbitrages it away.
Which I think, this is one of when people talk about applying the scientific method to finance, there's one key factor that they're missing, is that when you're trying to identify, like pressure in an oil field, and you understand the geological dynamics, and you grab that data, and then you apply it in order to exploit it or be able to pull something out of the ground. by watching it, you're not changing the dynamics, right? Like geology doesn't change, physics don't change, but the pure observation of markets by being a participant in it, this reflexivity that Richard has talked about, makes it such that if enough people are applying those new things, you are going to get a degradation of returns, if not an inversion of those returns, right?
You might call that the hard problem of investing, right? The idea of acting upon it and changing the very dynamic of the system that you're trying to engage with.
That's why everybody tries to keep their alpha quiet, right? Because the moment you say anything, it's gone in a heartbeat.
Well, yeah, you have to think about where you are in the adoption cycle, and think about as a manager, potentially you need to think about where you are in the adoption cycle and AUM fees versus performance fees and the sustainability of AUM in the face of performance. And so if you're very early in the adoption cycle and you can just do not simple rules, not the rules of tic-tac-toe, but sort of complicated, I'll call them, it's a complicated problem, meaning it's a bake a cake. Here's the recipe to bake a cake. Here's the recipe for the value factor. We're going to screen by these three things. We're going to do that quarterly. We're going to rebalance, and that should harvest the value factor. What that does not encompass is the fact that there's reflexivity in the marketplace and that the marketplace changes, and the nature of the problem is complex. It's the nature of raising a child. That's a complex problem. Each child is different. Each parent is different. Each time in their life is different. It's complex. It has feedback loops. It's not just a complicated problem. And so if you're early and you have market dominance, you can profit quite handsomely by marketing some easily understood cake recipes for these types of factors. But at some point, that's going to have some difficulty. I mean, DFA price to book. We've seen various specificity in the value factor failed first. Then it became more pervasive across any value factor that you tried to manifest, and potentially the better job you were doing, the worse it got. And so that's a really the markets are not a complicated issue; they're a complex issue, and I think it's a nuanced point, but it's a very important point as people think about this over a very long period of time. And how are they going to adjust? How are you going to adjust your behavior in order to reconcile that new piece of information? Is it just that you're going to do market cap? Well, that has its problems. I mean, the S&P took a long time to recover to the year 2000 highs.
11 years.
Yeah, and those small cap stocks that were suffering mightily during the 2000 bull market, they were having their bear market, much like today. We're having a full-blown bear market in the midst of a full-blown bull market in another sector of stocks. It just goes on. Rod, I can't hear you. I'm sorry.
So this is where it gets really tough to disaggregate these two concepts, right? The one concept that I think every value investor has really come to terms with is the idea of no pain, no gain, no premium, right? You have to be willing to take a massive amount of pain to be able to extract this value premium. And so when you present an individual that has looked at all the evidence using scientific methods and high p-value backtests and so on, they'll look at that and say, well, there's been other periods that have been this painful, and therefore that's okay. That's where I'm going to get my premium. But where does that end, and where does overgrazing begin? When is it that you've actually impacted the market so much that your belief that this is just suppressed returns because that's the way the factor works? Or is it there's just too much money in this right now? I mean, out of all the factors, and we've lived through this, right?
Yep.
The most intuitive is value. And we actually talked about this in our podcast with Wes and Toby, right? People like the idea of why do they like value? They like value because it's buying companies. You buy a cheap company. It's a good business. Buy it cheap. So is it any surprise that the premium, that's one of the premiums that has gotten hardest hit? How much of it is the actual premium? How much of it was overgrazing? And it's probably a little bit of both, right? But it's tough to extract yourself from that reality. But the truth is that everybody wants to be Warren Buffett in one way or another. And that's the first thing they're going to sign up for.
Yeah, I think you're raising a really good point, which is the fact that value has suffered perhaps the most out of all of the well-established factors makes sense given how it is the most intuitive one for most people to get behind, the idea of buying something that's cheap and has intrinsic value to it. So it was probably the first one to become overgraced, and it's still being sort of inverted and abandoned, as it has gone through abandonment for the longest of times because it was so mass adopted early on. So that's a really good point.
Yeah, you know what? Actually, can I share my screen? Because Claude Erb published a paper a few years ago that has since been taken down from SSRN. And I remember he had threw a little bit of a temper tantrum about something and pulled it off, I think. But how do I? Here we go. Where is it? There it is. Yeah. So this is a key slide from that presentation. So he just pulled from the Fama French database, and he looked at the rolling annualized 10-year return to the traditional long short factor strategies, value, the equity risk premium, trend, big up being large momentum, size, and large value. And what he showed was that momentum started very strong with an annualized return in the very beginning of about 12.5% a year, and has subsequently had, at least by 2011, declined to, over the previous 10 years to 2011, an annualized premium of about 7.5%. All of these are pre-trading costs and pre-borrowing costs and all the other problems that we're not going to dwell on today with traditional backtesting methods. But let's just call it sort of a 12.5 to 7.5. So the premium sort of declined by about 5% over time. The blue line is the equity risk premium, which has also declined over time, and which we can talk about some reasons why that might be the case. And then large value is the yellow line, where it started off with about a 6% annualized premium, and by the end of this, so this is 2011. So we're 9 years later. We haven't really seen value wake up much at all. And by 2011, it had already sort of demonstrated a almost zero premium. And there's been lots of published research in the last little while about the fact that the size premium, as originally published, actually there were some flaws in the publication or the methodology, actually in the data. So it was pretty overstated in the original publication, and then subsequent studies have sort of shown that there actually was never really a size premium. And then if you control for a bunch of other factors, then you might be able to surface a size premium, et cetera. But, just a really good example of just markets becoming more efficient in general, and investors catching on to a variety of these premia, and the effects that had on those the size of those premia over time.
Well, yeah, think about the discussion that you had with Murat too about institutional players coming into commodity markets and allocators changing the structure of commodity markets, the different structures of the market in China, A shares versus China A shares versus H shares, right? So the more institutionalized a market gets, it actually changes the structure. It changes the types of risk premia that might be afforded. And maybe you can dig into that. I'm going by memory. I think you probably had a deeper discussion, but I think
no, it's a really good example. And so in the very early 2000s, there was a trend towards institutions allocating to commodity indices, and the biggest one was the GSCI, the Goldman Sachs Commodity Index. And Murat and his co-author, by the last name He, I believe, they studied what impact this financialization of commodities had from the early 2000s until the peak of financialization and the peak of the commodity markets in 07, 08. I haven't read the paper, so I'm just going by I'm summarizing what Murat said. So I may be making some assumptions about the dates and stuff, but generally I'm directionally correct, I think. But what happened was, because the commodity indices systematically invested at the very front of the curve, so they bought the front contract, and then they consistently sort of rolled those contracts forward, as you need to do with futures markets. Then they pushed the front month up relative to the back month, and it created this backwardation, which then created a term premium in commodity markets. So here you have a situation where in the beginning, at least, the very active in people investing in commodities changed the structure of commodities to make it profitable for a while, where previously it had not been profitable. And it's so that was a really interesting dynamic.
A great example of reflexivity